So how does changing this interest rate affect inflation? How does changing the interest rate to increase or decrease disposable income affect inflation? Let me explain it from a consumer perspective. Let's say the interest rate increases. The Reserve Bank increases the repo rate, therefore the prime rate increases. It means every single month, when I was previously taking $1,000 and shopping at, let's say, Foschini, because the interest rate has gone up, I now don't have $1,000 anymore. I only have $700. So the people at Foschini, the owners, the proprietors, realize that the consumer has got less money to spend. And previously they were thinking of pushing up their prices by, let's say, 8%. When they realize the consumer's under pressure, they become a bit more cautious about increasing their prices because they realize, one, the consumer's got less money, and two, if they increase their prices too much, they could lose that customer. I could end up going to shop somewhere else, Pep stores, or whatever the case may be. So instead of increasing their prices by 8%, the folks at Foschini start increasing their prices by 4%. So they are still increasing their prices, but they're just increasing their prices at a lower rate, 4%, and not at a higher rate, 8%. Yep. So for a business, if interest rates have gone up, it's a double whammy because they can, one, lose customers, but also those customers are paying a lot less. They're buying a lot less because they've got far less spending power. Now back to Foschini's increase. If they increase only by 4%, it means prices are now still going up, but they're now no longer going up above our upper inflation threshold rate of 6%. They are now going up by 4%. So inflation has come back within the inflation range. Now, the process I've just described is called the transmission mechanism, where the Monetary Policy Committee increases the repo rate. That has a direct impact on the prime rate. That has a direct impact on how much people pay on things like car loans and home loans. That has a direct impact on the disposable income, in this case reducing it, and ultimately forcing businesses to reduce the rate at which they increase prices. That is called the transmission mechanism. I've summarized it. In reality, from the time the Reserve Bank or the MPC increases the interest rate to the time you're seeing businesses moderating the inflation increases takes 18 months. So the MPC talks about the forecast period. It takes 18 months for that to filter through into the results you see from an inflation perspective. So it's really a long-term process. And when the Reserve Bank and the MPC make their decisions, they're looking into the future, 18 months and beyond. That's how long it will take for the decisions to manifest in lower inflation.